Dzień dobry, witam Państwa bardzo serdecznie na panelu na temat systemu wymiany informacji kredytowej na świecie. Mamy gości międzynarodowych tylko, więc cała debata i wszystko będzie po angielsku, dlatego jeśli Państwo pozwolicie, przełączę się od razu na angielski i będziemy całość prowadzili w języku angielskim. Let me switch into English. So welcome everyone. There is the hot topic here in Poland, but in many countries in Europe, how to organize the credit information sharing industry and the platforms, the markets, how it should looks like. So in order to have a better view, it's always to see how it's organized otherwise. So we will start with the short presentation of the Collen Masunda from the World Bank. And Collen is the senior specialist at the World Bank, and Collen also serves the Secretariat of the International Committee on Credit Reporting. This is the body which set the standards about the credit reference agency, how it works globally. So it's always good to have a view from the global perspective, completely independent. And then I will invite our panelists, also international guests who are present here to the stage, and then we will continue the panel discussion. Collen, are you in? Good to see you.
Thank you very much.
The floor is yours.
Thank you for the introduction, and I'm not going to spend a lot of time on that. As indicated, my name is Collen Masunda, and it's my pleasure to be able to present to you on credit information sharing. I'll try to do a very quick and brief presentation, and please feel free to interject and ask me questions at the end so that we can be able to respect time. In terms of my presentation, I'm going to talk briefly about why credit information sharing matters, what we are seeing in terms of evolving models across the globe, and tied to that is the issue around ownership structure. How is it evolving with time? And I thought it would be good for me to close that presentation with giving you some information on emerging trends within the industry and close away with a bit of takeouts. In terms of credit information sharing, I think it's important to situate it in the context of how it matters for inclusive growth. And if we start from that basis, we can then be able to have a broader conversation on how it matters to specific stakeholders. For simplicity purposes, we've tried to pretty much bucket the economy into 4 subsegments, but we can expand it beyond that. There's always a general understanding on why credit information sharing matters for lenders, and I'm not going to spend a lot of time on that, except to emphasize the fact that we have seen that credit information sharing is now helping inclusion of previously marginalized segments of society through the introduction of alternative data and other data sets beyond credit, which I'm going to talk about later. And I think it's a very important point. Other than that, the issue about enhancing profitability, pricing is something that people are generally aware of. I think a broader conversation needs to be held around the importance of credit information sharing for the borrowers themselves. Because in most of the conversation, the borrower angle is lost, but it is actually a vital conversation in terms of how it enables access to those that are new to credit, but also for those that are within credit. When we start talking about risk-based pricing, how does it result and translate into actual lower interest rates that they get charged, and also better terms and conditions? For those that are new to the credit information sharing, how does that translate to things like collateral substitution or collateral complements? We have seen an emergence of a lot of data-based lending products, whether it's cash flow-based lending, it's other smaller ticket size products and so forth. The issue of collateral substitution is important. Beyond the lenders and the borrowers, the issues around the financial markets themselves becomes critically important. And here I want to talk about two important things. One is around the soundness and the safety of the financial sector. And one of the things that we have seen across market with the emergence of alternative lenders is that in markets where we started having disintermediation of credit information sharing, we saw an issue of over-indebtedness rising. And here it's a very, very important point to ensure that as we expand the group of financial institutions that are providing services to our borrowers, that is done in a responsible manner and it doesn't result in over-indebtedness. So the ability to have a platform or infrastructure that gives you a sense of indebtedness across the whole market becomes very important. The second point I want to emphasize here is around the issue of competition. In that, by having the information available, that information symmetry then engenders competition within specific markets. One development that we are seeing across several markets, particularly in the developed economies, is how credit information sharing is now being used for capital markets purposes. The example, and I think Elena is going to talk about it, how FICO, for example, has been used for securitization of pools of retail lending and MSME lending portfolios. So it also plays a particularly important role within that context. And finally, for the policymakers who I have simplified here as regulators, the importance of ensuring that both micro and macro prudential supervision is taken care of is important and cannot be overemphasized. But beyond that, there's a broader conversation around how you can use that information for broader policy formulation, formulating your credit policy, and so forth. That becomes very important. What we saw during the pandemic was that countries where regulators had access to credit information sharing, they were able to quickly identify the pockets where risks were building and as a result, calibrate their policies accordingly. And generally speaking, for those driving financial inclusion, they are able to identify segments of societies, but beyond segments of societies, they are also able to identify geographies where credit might actually be underserved and come up with policies that can actually assist that. What are we seeing in terms of models of credit reporting? Broadly speaking, there are three models. The first model, which is very prevalent in Europe, is where you have got either a solo or a coexistence model. So in a solo model, you either have just a public credit registry in a market, or you have just a private credit bureau in the market. And then the second model, which is also prevalent in Europe, is the coexistence model, where you have got both operating, but with completely different mandate. But what we have seen with the increasing emphasis on macroprudential supervision are hybrid models emerging, where there is increasing collaboration between both the private and the public sector, and there's sharing of information between the two. We have also seen of late, I think over the past 5 years, the idea where public enterprises actually decide to leverage the platform and the infrastructure that the private sector has built, and then rather than replicating development of another infrastructure, they just leverage the data that is sitting within the private credit bureaus. One interesting item that we have also seen is the emergence of specialized bureaus. For example, in Brazil, they've recently introduced a rural credit bureau, which is intentionally designed to promote inclusion in terms of their rural population. What is driving the differences in the models is pretty much the public policy objective, the size of the market, and capacity considerations. So there are some markets which are too small that you can't have both the public and the private, and you end up with one that is serving both purposes. And there are markets where, from a capacity consideration, you tend to either have a public or a private sector player. And finally, in terms of hybrid models, some of them emerged due to the public perception that there were market failures which the public sector wanted to address. In terms of database content, there's been a general move towards full file, which is both positive and negative information sharing, and also comprehensive information sharing. So we have moved from a period where there were segmented industries or subsectors building their own cluster of databases to one that is comprehensive, where both banks, non-banks, and even alternative credit lenders are sharing information on one platform so that everyone has a complete view to that. And we've also gone a long way from moving to sharing of just negative information, but to also sharing of positive information. In terms of ownership, what we are seeing is that there is an increase, and this is for just the private credit bureaus, because the public credit registries are predominantly owned by the regulators. In a few instances, the regulators do own them, but outsource their management to private credit bureaus. We've seen that with Ireland, with the Central Bank of Morocco as some of the examples where ownership still sits with the central bank, but they outsource some of the functions to the private sector. So from a private credit bureau perspective, ownership is tilting towards more of technical providers or private investors. When credit information sharing started, it was majority driven by banks and other creditors. And with the passage of time, we saw industry associations coming in also. But what we are seeing now is that there is increasing move towards the technical partners, and you can see that that industry is evolving and it's actually diversifying and expanding over time. One of the things that I thought would be interesting to discuss is around the issue of key emerging trends within the industry. And I'm not going to cover all of them. I'll just zoom in on a few. The first one is around the emergence of new players and data models. And this is both from a supply and demand side perspective. From a supply side perspective, we have alternative lenders, your buy now, pay later providers. We have mobile network operators, predominantly in the global south and a few of other countries which are emerging. And the issue with most of the loans that are generated by these alternative lenders is that they are short-term loans and small sizes. So high velocity short-term loans, which calls into question the issue of periodicity of reporting of information and so forth. Then from a data market ecosystem, we are seeing the emergence of data aggregators in markets where there's open data or open finance frameworks. And in markets where that has not been developed, we've seen an emergence of analytic companies who are playing in that space, but obviously trying to leverage the capacity that is within that context without proper regulations. The issue of changes in models, I've spoken to it. The issue of technology enabling access, processing, and analysis of more data. So we are moving just from credit data to data for credit, whether it's alternative data, cash flow lending, and so forth. And finally, in terms of this slide, the issue of customer empowerment and customer centricity, very important, driven by regulation in some markets, but also in other markets, driven by industry need to ensure diversification from just B2B, but also B2C. And then finally, also driven by the need to acquire additional data. The issues of cross-border and so forth, I think you'll be able to see that and hear about that as we discuss. In conclusion, credit information sharing is a very foundational infrastructure. I always give an analogy that as long as the road is perfect, you do not see its importance. But the day that the road has potholes, you realize that it becomes difficult to drive the generally low-bedded cars. There is no one-size-fits-all model. It depends on context and policy. It matters, but there's increasing emphasis on building collaboration, cooperation between public and private sector entities. Full file information and comprehensive reporting is critical, and it will help us in maximizing inclusion and risk assessment. The move from credit data to data for credit cannot be overemphasized. And with that, I think as we think about innovation, we need to ensure that we balance that innovation with sound governance, consumer protection, and transparency frameworks so that innovation does not then result in discrimination of marginalized segments. Let me pause there and tee over to Mariusz.
Thank you, Collen. Thank you for that comprehensive presentation. With that, I will invite our panelists here. David Bernard, who is the CEO of Equifax, responsible for UK and Ireland. Thank you. We have Petros Kapasouris, General Manager of Tiresias from Greece. And we have also Elena Koneva from FICO. Thank you. Senior Director for Credit Bureau Alliances. And we have Viktor Nagy. Who is Viktor? Oh, Viktor is over there. Former CEO of BISZ from Hungary. So we have the couple of different models, completely free from US to slightly more regulated in UK, similar model like we have in Greece, and controlled by the central bank like in BISZ in Hungary. So I would start with US, with the most open market. And if you say a few words about FICO, because maybe it's not well known from all of in the audience, and then if you can explain how the US market works. You are not the credit bureau. There are three of them. And
yes. Yes, sure. Thank you, Mariusz. My pleasure to be here. My name is Elena. I'm from FICO, as Mariusz said. We are not a credit bureau in the US. We are a company that provides analytical services on top of credit bureau. And we work with all credit bureaus. Just to describe how it works in the US, it's a very complicated market. It's like, as Mariusz said, free for all. So at the moment, they have 4 bureaus now, not 3. The 4th joined. I think the population and the variety of the lending services just makes them think that there is place for the 4th player at the moment. They all collect data on the consumers. They all collect positive data. They are all independent between themselves. And they all provide more or less similar services to consumers. So consumers can get from them credit reports, scores, fraud alerts, some analytical alerts, data checks, and so on. Working with all of them, we see like the variety of data, and we see that the profiles of the consumers could be like one consumer, myself, I can be in all 4 bureaus and have 4 credit histories in the same country where I live, that would all be possible.
4 different credit histories?
They could be slightly different. On top of that, I will have 3, for example, FICO scores, and when I will be logging into my account, I will have 3 more or less similar assessments, but they will be plus minus some points up, points down. Adding to the complexity, there are several versions of the scores on top of the credit bureaus. Bureaus do their own scores, they use our scores, there are alternative providers. There is very complicated regulation around that, because there's just one regulator called CFPB, Credit Financial Protection Bureau, again, Bureau in the name of the regulator, which adds just complexity to the consumers. And there's the Fair Credit Reporting Act, which is like generic regulation for all 50 states in the US. But each and every of the states can implement something on top of FCRA. So FCRA is the basic regulation, and in California, for example, they can impose higher fees or higher fines or additional checks or some more complicated rules on top of that. Plus, to add to that, USA is like UK is like the legal system is based on a lot of precedents and the court decisions. So to kind of, you can imagine the complexity of this ocean of different relations and different types of data collected and how it could be or could not be analyzed. So it's a very agile environment, I would say. But it regulates more or less itself with these just basic 2 things like CFPB, FCRA, and then just the practice and the usage. And maybe another significant trait of the US in comparison to the European markets is that the consumers are completely different. So their behavior is completely different. They are all very much educated in their credit reporting situation, in like how they are assessed by the banks. They have a very good risk-based pricing offers. So every consumer, he's kind of incentivized to have a perfect, ideal credit history, to have a perfect assessment, because it just gives them lots of much more benefits that they can at the moment have in like generally in all the other countries. And as Collen mentioned, the scores and like the credit history, it penetrates so much in the credit system that they use like all these things for securitization. It's kind of, it's not just the lending process, it's assessment, it's in collections, it's in employment, it's in infrastructure, we'll probably talk about it later. So it's in many, many, many layers of the life, regulated from various angles and sometimes different in like, on the range of 1 mile and with a lot of players.
Do you know if the credit bureaus in the US, they're using the credit data for the marketing purposes as well?
Yes, they do. Yes, they do.
Okay, so David, how it looks in UK? So if you could also say a few words about the Equifax.
Sure. So Equifax is a multinational bureau. We operate in 25 countries across the globe, both a consumer bureau and commercial bureau, so data about individuals and data about businesses. We also do things like decisioning platforms, analytical platforms, fraud prevention, identity, etc. Maybe to illustrate the difference from what you were talking about with the the US tends to have a fragmented view where not everyone reports to every bureau. So there's not as much overlap as you would find in other countries where you have several bureaus. In the UK, the 3 main bureaus actually have very much in common in terms of the data. And it's going to align perfectly because we have a new regulator coming up, the CIGB, that is about to mandate data sharing for all lenders and mandating even the data models, etc. So you're going to see convergence on the data that feeds into the bureau. The secret sauce is not so much the data that comes in, it's how you match it. If you have John Smith, is that the same person? How do you avoid fragmentation? How do you match people, etc.? Those people move, those people change names, those people, etc., evolve. So it's a 3-bureau market in the UK, all private sectors. They're the 3 main global players. Very competitive. We actually expect more new entrants into the market on the back of that new regulator helping new entrants. So there's several that have been declared. I should add also that it's both negative bureau data, so people who haven't paid something, as well as positive. So the more you repay your credit card balance or your mortgage, the more positive data points you have. And it's combined for the three bureaus across what we call the Consumer Bureau and the Commercial Bureau. So as a director or officer or shareholder in a company, you will be in both data sets. Last but not least, it's also used for identity purposes. So if you want to open a bank account, typically in the UK, the bank will tap into the bureau to say, do you know that person? And there's a knowledge-based authentication, typically in addition to things like the selfie and everything. Something that I wanted to point that was quite prominent in Collen's pitch. When you have a well-functioning, quite competitive credit bureau market, it means that everyone pays less in interest because it's a more transparent market. So you know who's more likely to pay back, you know who's more likely not to pay back. So it's more transparent, therefore the pricing of the risk is different from the banks. And second is, the more consumers and small companies are educated about credit data and credit scoring, the more they want to improve. So it's self-perpetuating and self-improving because people care about their credit score or whatever proxy, there might be different scores, etc. But all of a sudden, they actually pay attention. They know that they need to register on the electoral roll. They know that not paying or being late matters. So it improves the situation over time, and it creates a dynamic, well, a quite transparent environment. And last but not least, it's very important to have a regulator that sets good rules. They bite enough, so there's enough data, but also they protect the consumers, and there's a lot around consumer duty as well. I'll probably stop here.
Thank you, David. Do you have the data from the utilities, from telcos?
Yes, I should add, so it's not just lenders and banks in general. We also collect data from utilities, telcos, etc., and as well as a variety of data sources like the electoral roll, etc. Telcos typically started because you don't pay your bill upfront. So as soon as you have something like your water bill, your electricity bill that you don't pay upfront, it goes into credit data because it's at the end of the month, so they kind of want to know that you're going to be paying back. But obviously, most of those telcos have moved into handset financing. So you put your iPhone and you reimburse it over 3 years. That's lending, typically. So the lines are blurred as well.
David, could you say a few words more about the upcoming regulation, that there would be the obligation to report to everyone, and there would be separate license for run the credit bureau? Could you say a few words more about that?
Yeah, so that new regulator has been established under the auspices of the FCA, the main sort of finance regulator. They're called the Credit Information Governing Body, CIGB, so they have already like 5 or 6 permanent staff, establishing working groups, etc., and organizing subscription with all clients of credit bureaus right as we speak. We have a number of new entrants that have declared themselves, 2 or 3 of them already. So we expect the number of credit bureaus to go very rapidly from 3 to 6, 7 or more. So it's going to get interesting.
Thank you, David. So can we switch to Petros? So if you could say how the market is organized in Greece, and what is the role and the governance structure of Tiresias?
Okay, I will tell you a few words about Greece, first of all, because as Collen said, that the size matters of the market. Greece has about 10 million people, about 17 million records we update every month. Half of it are closed records, half of it are current records. And we have 4 banks that they control 98% of credit. So Tiresias has 100% of the credit lines in Greece, including BNPLs, microfinances, and any other letters of credit, letters of guarantee, etc. And we are owned by banks only. That's the model that we have, the interbanking system controlling the credit bureau. And we have only one credit bureau. We also provide business data, and there is another company that provides, private company that provides business data only, but not the credit lines of businesses. credit lines are only controlled by Tiresias. Now, the way it works, it's an extremely, it sounds that probably it's a not efficient company in some way because it's controlled by institutions, etc. But you have to imagine that we are not just controlling by institutions. We have customers, the institutions, which they control about 250 billion euros in loans. So the pressure is from the management, and the pressure is as customers, and also the pressure is also as suppliers, because the banks have the triple role. So we are, say it simplicitly, we are surrounded by banks. So we have to be correct because they're customers. We have to be cost effective because they are owners. And we have to be trustworthy because they are suppliers of their most valuable assets, which is the customer base. So the pressure on us is we're surrounded. We're not owned by a government that we are forgotten in one corner, as somebody would think. Therefore, now, the way we run the business is we have always to imagine that banks are competitors, but also are collaborators. On the credit bureau side, they are fully collaborative, so we don't have conflicts, I would say, and we are lucky to have 4 banks of similar size, so we have strong governance. So we don't have so much divided interests in our governance, because all banks have similar size and similar products and clients. So they have common interests. So now the pressure on us from the banks, it's great, because just because we are a medium-sized country and we have medium-sized income and revenues, so we have medium capabilities on expanding technologically, or have advanced algorithms and become expert in a breadth of systems and depth on fraud detection, in credit estimation, in specific BNPL scores or whatever it's needed. We could say we don't have so much customers, we don't have so many revenues, so we cannot follow everything in the expertise of a large organization like FICO or Experian. The bad part on my side is that the banks control 250 million on credit, so they're not accepting anything less but the best on every aspect of progress or operation of credit bureau. Therefore, what we do collaborations. We'll collaborate with Equifax, we collaborate with model building companies. Actually, we acquire one, and we have a model building small company to provide integrated solutions to the customer. So that's the one aspect of interbanking company. The benefit now we have for the banks and the drawbacks. The benefit is that we create products with interbanking committees, so we get all the expertise from the banks to create products that the customers want from the design phase until the end. So that helps us a lot on marketing and sales, because the product is essentially built custom to the banking system, which is the biggest part of the market, the biggest pie. The second part is that we emphasize the collaboration, so we don't have conflicts. They never intervene on technical stuff. I mean, they will not tell us for this scorecard we need to be a little bit more relaxing or a little bit more the opposite. They want to know exactly the truth because they pay for it. So, and if they don't have the truth, that's costly. Just to give you an example of the usefulness now of the credit bureau from real red loans or BNPLs. Everybody knows about the Greek crisis, 2010. 50% of the portfolio went BNPL. So one would say, okay, how come Tiresias...
BNPL or NPL?
NPLs.
NPLs.
The Tiresias operates since 1993, let's say. How come we had all these NPLs? The reason is the 2002 decision of the Data Protection Authority was to receive only with consent the loans, the new loans. So we lost all the mortgages that they are long-term and all the cards and all the overdrafts, etc. 2009, they gave us all the loans in Greece without consent to concentrate. Just to give you some examples, real examples from customers. 32 cards, credit cards, on consumer, 600,000 in balance on credit cards, 5 million in loans and 5 million in collaterals. And we examine not only for him, but I say it indicatively. Up to 2002, it was 18 cards. For 2002 that we started having with consent. After 2002 until 2009, he receives the rest, and from 2009 that the banks get the full picture, not even one, zero. So, if they had the big picture from 2002, the question is how many of those NPLs would not have gone to red or to default or become NPLs actually. So it is extremely important the creditors to have the full picture to know what they're doing. Now, in Greece, we have also a database in the Central Bank of Greece. They collect the data because they want to be, for policy purposes. They will not score, and they don't use it for credit acceptance purposes. They use it only for, in the statistics department, to generate policy. Imagine if a central bank creates a score. Every estimation that, I'm talking now as an electrical engineer, every estimation has type 1 error, type 2. Electricals call it false detection, false alarm. The bankers, they call it type 1 or 2 or whatever. So if a central bank of a country issues a score, what he has to say about a false accept and a false reject? It's not so easy to handle the situation. We have another database of the public data. One ministry collected all the public data in a database, and there's a law in Greece that it allows us to exchange scores. So when they are ready, they collect the data, they have not created score yet, but the law says that we are going to provide our credit score, they will provide us the score from the public, from taxation and insurance, public insurance, etc. So that's helpful because it will expand our population, score of our population, and it will increase the accuracy of the thin files. So this is a way we have planned it in Greece.
So Petros, you have the access to the public data from the tax office?
No, we have access on the ID data from the taxes office by law to make sure that our reference file is correct.
So you're making the credit scores based on the tax office data as well? No,
just the ID.
Just the ID, okay.
Name, last name, taxation number, ID, etc. Not financial data.
Have you got any special supervision authority on you?
Except of the banks that we have the triple supervision that's strong enough. We have, of course, from the data protection, but we don't have a special authority that
supervise you. Okay, thank you. And Viktor, that you have the different model, so if you could say a few words about the BISZ and the Hungarian market.
Okay. Thank you very much. Well, there are certainly similarities to Greece because we have the population of the same size, like 10 million-ish, a little bit less in Hungary, 9.5 million. And there is only one credit reference agency in Hungary. But otherwise, it's totally different because the Hungarian credit reference agency is owned by the central bank indirectly, because directly owned by the Hungarian clearing house, which is owned by the central bank. So it's a public company in this way, and it has a monopoly. Why there is a monopoly? It's because of the regulation. There is a special act that actually regulates our operation in Hungary. Every banks and financial institutions who has a credit granting license, they have to report to our database all the loans. So we have full coverage of the loans, even individuals and corporate side, and negative and positive data as well. So we have lots of data. We have all the credit agreements data in Hungary.
Have you got the data from the leasing and the payday loans, BNPL providers as well, or not?
They are all considered as a financial company. So leasing companies, even debt collection companies, payday loans, but that's not really popular in Hungary, just like the BNPL. It's not that popular right now. Maybe in the future it will become more widespread, but not now at the moment. But they have to join to our database. It's an obligation for them, and report the data in 5 business days if there's any change on the loan contract. On the other hand, there is a heavy regulatory burden that we have to meet. Strict rules how to use the data and what purpose the data can be used. Basically limited to creditworthiness assessment, and Collen said that there are different types of models. I would consider BISZ as a hybrid model, because it's mainly a credit registry, but with some credit bureau features. Because we can offer optional services, not just compulsory services. We can offer optional services as well in the frame of the regulations, so we have to comply. For example, we have benchmarking services, early warning services like monitoring services as well. These are optional ones, and in this way we can actually price this as we want to price and as the market needs and will to pay for it. On the other hand, the obligatory service, that credit reports, they are priced, the pricing is not that free, I would say, because it is very much controlled by the central bank. Actually, this ownership is not was always like this. In the past, the company was established by a group of top banks, maybe similar to big as well in Poland, and that time the focus was on the results and of course the costs. And the price as well. The banks wanted to keep it low because they had to pay for the price, and there were some services and new services and some service developments as well. But sometimes there were conflicts of interest between the banks and the owners. And then the crisis came in 2008, and it has the focus from the regulators focus started to look on the operation of the company, because before that there was no special act of its operation, and there was a shift in the ownership as well, and the focus went on more on the financial sector's health as a whole. Both ownership structure were open to new products and services as well, but from different angle. The priorities were different. So so that's the short description of the Hungarian system.
Thank you, Viktor.
I was about to say, it's interesting because it's not an easy proposition to build overnight. You need the data supply and you need the distribution. So there's a little bit of a chicken and egg situation, which is why in many countries it starts with one. And it starts either because you have a core group of banks that want it collectively, or because you have the state that gives that impetus. But you need either a critical mass of banks or the state to make the first step. And then it gathers momentum, and then you may have a regulator that says, okay, we have one, we can have a second one or a third one, or a group of banks or a group of telcos that build something on the side, or a group of specialist finance providers, either doing leasing or doing BNPL or doing something different. And they build, again, another segment of the market. And maybe after that, there's consolidation. But the reason we're talking about a small number of players in each country is because it's hard to break that chicken and egg situation to start with.
It's very much true. It's also about the platform difference. Like we have the credit files, but the fraud prevention, we need to build the critical mass. And then when we have the critical mass amongst the players, then there's like this snowball. Then everything will join sooner or later to the system. But at the beginning is very difficult. Like we set up our fraud prevention for the credit application. It took me 7 years to convince all top banks to be on the platform. It was really long time to have a mass scale and being the uniform. But I have a question to Viktor, the supplement. Do you do the scores for individuals or the banks, or do you have the service for individuals?
Score is a special thing we would like to have. At the moment, we don't have any. Even on individual side for the individuals, and not for the corporates either. The problem is that, as I mentioned, the regulation, it is very strictly regulated what we can do with the data. On the individual consumer side, the biggest opposition comes from the Data Protection Authority, because it's profiling and GDPR, and they say that this database is not meant for this purpose. So it needs a change in the law. That actually we were very much lobbying to change, and maybe the momentum comes now. We'll see. On the corporate side, it's different, because the data protection officer doesn't really, we can say, care about the corporate side. So we are actually working on a scoring model for corporates, but it's not introduced yet.
And what about the fraud prevention? Are you allowed to do any platform solutions?
No? We have no authorization to use the data that we have for fraud preventions, but that doesn't mean that we cannot have any other solutions that is not using this kind of data for fraud prevention.
I can come back to Elena and David. You know that the data you can use for any other purposes, for the insurance, rental business. And could you say about the cross-sectoral correlation between the credit data and the other data based on your experience?
Well, the closest would be insurance, of course. So because it correlates a lot, the behavior in credit risk correlates a lot with the behavior with the insurance, and they also have these risks of, I don't know, someone who is not attentive to his loans, usually not attentive to his equity as well, in general. The next would be closest telcos. Then in some places in US, including employment, especially on the financial position. So when you are dealing with the money, you are accountant or your CFO or whichever financial person, rents, lettings, to find out that the people who are renting or your flat, they are trustworthy, they're not over-indebted, they are good in what they are doing. Sometimes car rental companies look at the scores, and all of a sudden I find out in the UK they do some from time to time, so they look at your scores. It can go to some extremes, so I wouldn't say it's kind of done reasonably all the time. So there could be cases that kind of overuse it, and in some places it's not used. But in general, this credit behavior kind of reflects the the planning capabilities of the individual. Like, can I manage my money? Can I plan my activities? Can I predict the future, at least at like the simplest, my next steps in the next 3 months and so on. So the places where that could be used is huge in marketing and making pre-approved propositions, or just monitoring the market and building your own product strategy, for example, looking at like how the population looks like. In the US specifically, there's lots of this fair credit reporting, so they're very much limited on the discrimination perspective, which could be different in other countries. So maybe in some other countries they have more flexibility. US is very regulated from this perspective. For example, usage of postal indexes is a big question there, so that you do not discriminate people from one neighborhood towards the other neighborhoods. But in general, it comes not only into the financial part of the life, it comes into day-to-day life.
Yeah, I can give you a couple more examples. There's a big market in the UK and in other countries around what we call aggregators. So websites, we call them public comparison websites or price comparison websites. So you go there to shop for mortgages or credit cards or loans. So typically you'll have a panel of, say, 50 lenders or 50 credit card companies. And as a consumer, you put a few details, and all of a sudden you get like offers. The magic is to make sure that those offers are real offers, not just theoretical, because people want the right interest rate with the right conditions, and they want to know that they're going to be accepted. Not just for the convenience, because if you apply for a credit card, you get refused. It's actually, it marks your score down in the bureau. So there's subtleties around creating models that work with slightly different data inputs, which is usually a small common denominator of data, and you host those models for the lenders, and then you run that. But I'll give you another example, which is that we use a lot more than
David, it's very popular in UK, but in the other countries as well?
US, pre-screening, of course.
UK, US, but continental Europe as well?
In several countries, yes, but it's not as developed. I mean, typically in the UK, you'll shop around for your mortgage every 2 years. You don't like sign up for 20 years or 30 years. You shop around every 2 years. Every 2 years.
Wow. 2, 3, 5 maximum.
Yeah. So very competitive. Same for credit cards. People sort of change credit cards all the time. They change electricity providers or insurance providers every year, every 2 years. So extremely competitive. People have very, very thin margins. I'll give you another example, which is that typically when we do build the system for a bank, it's not just origination decisioning based on a credit bureau and the core file of the bureau, but we'll apply what we call an affordability calculator. So not just, is that a good payer, yes or no, how much could they afford? So we'll typically use a combination of 3 main data sets. One is the core bureau Are they a good payer, typically? 2, an open banking pool. We get 3 months or 6 months of data. We analyze patterns, on-fly categorizations into hundreds of categories of incomes and expenditure. We detect signs of, gambling and behaviors, and not just what people don't pay, but also other things that they pay regularly, maybe Netflix or rent or something. And a third is what we call CATO data, the current account turnover data, which is another data set where we get from most banks how much money goes into the account every month, how much money goes out, and essentially ratios of turnover. And also we get identity data on that, etc. So we combine many other data sets on top of the core credit bureau to give a very detailed picture of that person saying, they obviously have a commitment to write childcare here, private school fees, rent. How much could they squeeze to pay more on their mortgage? Or do they make one-off commitments to go on holiday? Do they withdraw a lot of cash just after payday? And loads of signs like this that will give you an additional sign on top of the credit bureau. So it tends to be quite sophisticated nowadays.
Do you believe that the open banking aggregators, the fintechs, the operating, they are big competitors for you, or just the complementary? All of you, or most of you, they're using the open banking, but there are some open banking aggregators outside the credit bureaus as well.
Yeah, so most of the large credit bureaus have acquired or developed open banking capabilities, and we do that typically across Europe and the world. Open banking is generally not sufficient on its own because it's what's being paid. You can see. What you can't see is what's not being paid or when it's being paid late. So it's not as good, but it's quite complementary.
In Hungary, we were really looking at this open banking solution, if we can start something like that in cooperation with anyone. But right now, what we see on the market, that the banks itself, the top banks, they develop their own solution, open banking solution, and actually they want for themselves. And once they have it, they start or willing to start to monetize it. It's like, I can give you an example. In Formula One, there are 10 teams in Formula One, but they are using just 5 engines of different manufacturers, like Ferrari, Mercedes, Honda, Red Bull, so on. So they are actually selling their solution to their competitors. They use it for themselves, the engines, and then they sell it to others as well. And that's what I see in the Hungarian markets, that the trend is something like this. So the big banks, at least OTP in Hungary, they are developing their own solution and then monetize it too.
On the open banking and also the GDPR issue. On the open banking and the GDPR issue. What we've done in Tiresias is, because all the credit lines we have, it's for interbanking use. We cannot use it in the market. So how we manage to use it in the market widely? We started the bring your own data concept, which is the open banking, call it open Tiresias, not open banking. So what we've done, combine it with an application that we have in the mobile, you can draw your own report and you can use it as a potential borrower. So you want to go to a business to borrow, to take some credit, let's say conveniences, you can bring your own report, and because it's your own report that you get it online in real time in your mobile, you can use it. Immediately we solve the problem of GDPR, because it's compliant by design, since they use it, and in that sense we can go in wide use. Right now in Greece we start having demand for embedded finance, cash advances, e-commerce that they want to combine credit bureau data with consumer type of data to improve the score. So we go away from the general score and we go to more sophisticated scores, like for example BNPL, we have a different score, that it goes segmentation on the market, on the customer, and on the sector, etc. So the trend that we see in Greece from the demand side is to go to more sophisticated scores, more data, and more concentrated data that combines customer data and credit bureau data to create, and all that is possible because of technology, of course, because right now the banking in Greece goes from the banks to the customer rather than the customer to go to the bank. So Tiresias following the exchange, it has to go to the customer itself.
Thank you very much. We are end of time. However, can we just one question? One question about the future and competitiveness. Do you feel what would be the future in your countries, and maybe Collen could go beyond that? Will you compete between other credit bureaus, big techs, fintechs, or the telcos? They will be building some credit bureaus. There are some examples in Brazil, for example. But what would be the future? 2 sentences.
Okay. For us, the future, it has 2 directions. One is for the bureau to go close to the customer and be part of the offering, not to be data provider outside of the offering, be part of the product, increase the value of the product and go close to the customer. The second one is, of course, to, after we're in the phase of the models now, scoring models of affordability, model of this, model of that, to go to the agent side, meaning to start having, but this is the next phase, and that's how we will protect against competition, which is, as we said, big techs, fintechs, or whatever.
Very quickly for me, the future is AI, and AI needs good data. It needs clean data, data that is available, etc. So, well, 20 years ago, banks will pull a credit file and manually look and make a decision offline. Nowadays, as consumers, we want immediate satisfaction. You typically have an embedded finance, you buy something, it's 500 euros, click, and there's a decision. In order to do that, you need clean data, you need good data, you need cloud, you need APIs, and you need AI. So I think having clean data sets that work at speed, at large scale, because retailers cross borders typically, means that for me, AI in decisioning is becoming more of a thing.
Competition and speed. We had 3 bureaus in the US, now we have 4 all of a sudden. So of course there will be more players. Instruments become cheaper, more available to everyone, not necessarily fintechs or big techs. So the competition will come from the tiny small companies that are not even companies, maybe individuals.
Agreeing with David about the AI, but specifically in Hungary, in the future, we expect some regulation change, more towards more enabling regulation, because that is inevitable in Hungary, because we are kind of lagging down, far behind. So that's my expectation.
Thank you. Collen, one last sentence from you.
No, thank you very much for the interesting conversation. 3 things. The first one is we have already moved from credit data to data for credit, and we are going to continue seeing consolidation on that. Open finance is a complement, not a substitute. The second thing is we are moving to real-time information sharing. With short-term loans, high-velocity loans, you need to be able to share data real-time. The third thing is customer focus. I'm not going to ever emphasize it, but hyper-personalization and permissioning is going to be key. And the fourth one is around data hubs. In markets where you have more than one credit bureau, data suppliers are getting frustrated in supplying 15 reports to a lot of bureaus. And customers are frustrated by inconsistencies in data. So for regulatory compliance and data standardization, we are going to see hubs. And finally, cooperation and collaboration is going to be the game.
Thank you very much. Thank you, our guests, Viktor, Elena, David, Petros, and Collen. It was the pleasure hosting the debate and the panel discussion. Thank you very much. Big applause for you.